Hello and welcome to the Life Settlements Podcast with your host, Mark Markey and Rob Haney. Guys, good to be with you again. It's been a while. Hope you've been okay.
It's been a while, Bill. Good to see you. Good to connect with you again.
It is indeed. Rob, good to see you as well.
Good to see you too, Bill. This is our holiday push.
You've got an interesting guest on today, guys, and I will make no secret of the fact that I learn something every time I am involved with this podcast and listen to it. So without further ado, I'm going to shut myself up and turn it over to y'all. Mark, lay it out for us, buddy.
Well, I appreciate it, Bill. Elon, thanks for joining us. Rob, as always, thanks for joining us. And why are we here today? I've been involved in the settlement industry for 23 years. My partner, Rob, a lot longer than me. I read a lot. I go out to social media to see what's going on there. And I keep seeing our guest today, Elon Mose, and his clips regarding universal life policies. Why does that matter? Well, I would say, and Rob, back me up on this, 70 to maybe as high as 80% of all life settlement sales, the policies that our buyers purchase from a broker like us, are universal life in nature. Would you agree with that, Rob?
I would absolutely agree with that, Mark.
So why is Elon here? Well, Elon's got a book, and I'll let him even introduce his book, and I'll put it up on our screen here. He writes in his title, Lapsed, the Universal Life Insurance Whistleblower, an expose of MetLife's Universal UL, Variable VUL, Group UL, VUL, and the industry's index universal life insurance policies. So I thought to myself, why is that important? Well, Elon, and we're going to get to you talking here soon. I know you're a quiet one, but what you point out in this book is highly important for individuals, whether they've just taken their policy out and they're in their 40s or 50s, or if they're now in their 60s or 70s or 80s and they own a universal life product and they're faced with their current statement, it's not worked out, cash values are down, premiums are going up, and we want to know why. Well, why did that policy perform that way? And why and how does the life settlement industry help me out as a consumer who owns that type of policy? So Elon, I appreciate you being here today. Tell us a little bit more about your book and why you wrote it and what your feelings are on universal life and that type of product.
I should share my feelings with the group. So I was a subprime, my degree's in real estate. I was a subprime mortgage underwriter for Merrill Lynch in 2008. I saw the subprime crash happen. I had a toxic resume. After college, I was an investment broker right during the dot-com crash. So twice in my career, I saw that Wall Street or the powers that be were not protecting the consumer. And everybody was pretty much happy with the status quo as long as they were making money. And that's the big Wall Street people. So when I got to this field, my antennas were up. 2008, middle of the subprime recession, had a toxic resume, walked into a job fair, was hired by MetLife in 3 days, actual 3 business days. And I became a financial advisor. And within the first month or so, I met somebody who wanted life insurance and needed to save for retirement. And one of the senior advisors, in really big air quotes, said, why don't you sell them a variable universal life policy, which is what I did. And that's the only one with my actual signature on it. And a few months later, they must have sent me a duplicate of the policy. And I actually read it word for word, like the guy from Boiler Room. And I saw at least one red flag, even though I had no idea what I was looking at because I was still new. I was like, I can't write this policy. And that's when I shifted to whole life immediately. And the thing with whole life is once you really understand whole life, you really understand why universal life doesn't work. The designs are outright idiotic, I think. And I don't think anybody financially literate could ever purchase that product. And I just came to a point to understand that the people who were selling them were either greedy, they wanted commission, or...
Yeah, and I'm going to ask, why doesn't UL work? And I want to hear your answer, Elon.
Okay, so up until the late 70s, whole life was the predominant policy for well over 100 years. It was based on a guaranteed premium, a guaranteed payment, a guaranteed death benefit, and a dividend not missed in over 100 years because 98% of term insurance policies expired worthless. The insurance companies have an awesome business model. The problem is interest rates hiked up in the 70s, early 80s. Interest rates became 8, 10, 12%. And that means, Mark, your dad who bought a policy in 1960, a nice little whole life policy from whichever company it was, said, wait a second, I'm 50 years old. I'm probably earning 3.5% to 4% guaranteed in my policy, but I can go out and buy a money market for 8, 10, 12%. And that's what happened. The insurance companies feared this mass exodus of cash value from their whole life policies and created universal life policies. The problem is, if whole life was bundled, you could not separate the savings from the investment, from the cost of insurance. Universal life separated not only the investment, because it wasn't a savings account like whole life, but it separated the cost of insurance. And the way I explain this to people conceptually is, if you bought a $100 universal life for $100,000 a month, as a 30-year-old, the first premium asks a question. What's it cost to insure Mark, who's 30 years old, for $100,000? And it's $20 a month. The cost of insurance is negligible because the chances of death are slim to none. And that means that $80 is invested in then money market rates of 8, 10, 12%. The following year, when you're 31 years old, because you're now a year older, the cost might be 21. The difference invested in the money market, 79. And there lies your first problem, rising cost of insurance. The second problem is, because these policies were designed utilizing the 1980 census or CSO table, which suggested death at 77 or 78, and people are now living until age 100. Jimmy Carter is 100 years old, and I think on my LinkedIn post the last 2 weeks, one guy passed away at 107 and a lady passed away this week at 115. So you have rising costs inside the policy. You're going to outlive the census design by 15 to 20 years. And more importantly, from a Wall Street perspective, and don't get me started on the life insurance sector analysts. Please let me get started on that in a moment, because I want to nail them to the wall as well. They forecasted you to make an 8 or 10% CD-like rate of return eternally in your money market. And guess what? When you show somebody 8 or 10 or 12% in these universal life, index universal life, variable universal life policies, the insane linear return that they're showing forecasts you to have an enormous amount of cash value. But in the case of universal life policies, which were predominant in the 1980s, 90s until the early 2000s, interest rates went to zero in 2022 because of COVID-19. That means you underperformed the investment hypothetical assumption offered to you at the point of sale by 3 or 4%. And if you're upside down by 3 or 4% in a universal life policy, that means you won't have as much cash value. Now, to get a little dorky here for a second, what the main concept here, there's a big concept called net amount at risk. So if something happens to Mark, I deliver a $100,000 death benefit to his wife. Because I'm holding $10,000 of cash value inside the policy, so the net at risk is minimized in the original illustration because you were forecasted to make 8, 10, 12%. When real rates of return end up being 4, 5, 3, you have a lot less cash value, a much higher net at risk, and the net at risk is what's calculated based on your future age.
So that's where I want to jump in. You just pointed out a few things, which is what we see in the life settlement industry every single day. When I get a projection that's sent to me from a consumer or even from an advisor, a lot of time that life insurance illustration projection is ran to age 85 or 86. Now, you just mentioned that we've got rising interest rates. Then you throw in cost of insurance increases. If a client lives past 85 or 86 as that projection was given to him at 7, 8% return, what's that policy going to look like when he hits his mid 80s to late 80s, Elon?
Well, when we look at the net amount at risk, let's say you have a $100,000 policy with $50,000 in it, and you're 90 years old, and you bought it 20, 30 years ago using the 1980 census. They ask a question: what's it cost to insure Mark, who's 90 years old, for $50,000 net at risk, who was supposed to be dead according to the census design 12 to 13 years ago. I wouldn't want to take that bet. Unfortunately, you have to. You, the consumer, must. And because those costs could be 8-10 times your annual premium of $1,200, it only takes 4 or 5 years to completely liquidate the cash value inside the policy. And once you start going downhill, it's a high cost avalanche because your cash value is depleted by rising costs, your net at risk rises because you have less cash value, and you're 1 year older. But the bigger problem here is the consumers are not given the in-force illustration, which is the current policy projection on an annual basis. They think the illustration given to them by the guy or gal who wrote the policy, who may have been their BNI networking friend, their cousin, their neighbor, the coach that coached their kid's soccer team, they think that illustration is holy, when in fact all it is an investment hypothetical assumption of what the policy might do. And the insurance companies don't want you, the consumer, to have that policy, the in-force illustration, the current projection, because the minute you receive it, you're going to realize that you were sold some magic beans. You're not going to climb the beanstalk. You're going to be left with nothing, right? So the industry is more than happy to keep my book down and out of the spotlight, because all I'm doing is asking for a simple, rational idea. Send an in-force illustration to every consumer so they could see what their current policy projection is. And when they see that 0 with the asterisk, which says their policy is lapsed, hence the name of my book, or ceases to exist while they're still alive, then they have 20, 30 years to make that decision to exit it. So the problem is a lot of parents don't tell their own kids about their life insurance. So the kids don't know, the parents don't know about this in-force illustration. They just assume they're going to have life insurance until the dreaded day comes when they receive what's called the demand letter. And the demand letter basically tells them, hey, Joe, you got a $100,000 policy, which was costing $100 a month, but you have to dump into this policy $8,000 to keep it afloat this year, cost of insurance. And guess what? Most people in the 50th percentile on $1,200 a month Social Security, negligible financial assets, no 401k, simply don't have $8,000 or $10,000 to dump into the policy. And then what happens? The policy lapses. And what it means is Mark, as a 30-year-old, may have paid 50 years of a $100 premium, which is 60 grand, had 40, 50 grand of his cash value depleted and didn't get the death benefit. And that means the damages to you between the premiums, the lost cash value, and no death benefit could be 2x your originally death benefit. So that $100,000 death benefit could, in fact, be $200,000 worth of damage to you.
Which is where, our industry steps in. As I mentioned in the beginning of this podcast, 80% of what the life settlement industry sees, whether you're a provider on television or a broker like us, 80% of what we see is some UL product that was taken out 10, 20, 30, 40 years ago. The projections ran to a client mid-80s. It was run at 8% or more, showing that return. Yet here they are now in their 80s. Cash surrender values have gone way down.
Correct.
Cost of insurance is now going up. So that $1 million policy that they took out for 30 grand that was going to last them their lifetime. Well, they're now living past their lifetime as it was portrayed by the insurance carrier or advisors. Rob and I just returned from the Life Insurance Settlement Association meeting, and it was a topic of discussion by several life expectancy, I'll call them experts. These are companies that groups like us go to for a third-party life expectancy evaluation. And all but one of those life expectancy third-party companies agree that if you're a life settlement client, you're typically someone that's mid to higher net worth, you're someone that has access to medical care, you're someone that will take your doctor's orders, well, you're someone that's probably most likely living to your 90s. Standard mortality, as some life expectancy carriers will say, on a male is to age 93, female 96. So again, back to Elon's point, if you took that policy out years ago, even if you funded it the way you were supposed to, but now you're in your late 80s, you could be in a lot of trouble, which is where our industry steps in. And the latest industry averages, which if you listen to our podcast, we get consumers, 2023, Rob, correct me if I'm wrong, 2023 industry average was that a client who sold their policy via life settlement got 6 times the cash surrender value.
6.5 times more their cash surrender value.
Yeah, which is, it's so important. We're not here to bash insurance companies, insurance agents. We're simply to point out some facts that maybe the consumer was not aware of. Maybe the life insurance agent, maybe the guy who brought me the policy, it isn't even the agent of record, which probably happens 50% of the time. But now they have
that. When they write that policy, and it's my job to bash the industry. You could just nod in approval. That's okay.
Yeah.
The guy that wrote the policy for you, the last thing he wants is a long-term relationship with you because it's a hit and run sale. He sold it to you based on a hypothetical assumption that never happened. And by the way, it's in all 3 major policies: universal life, variable universal life, and index universal life. The investment assumption is outright, for lack of a better word, idiotic. And I could probably put an expletive before it, right? Okay. Universal life policies were showing 8, 10, 12% linear rates of return in money markets, and money markets crashed to 0. Variable universal life policies were showing an 8 to 12% CD-like rate of return, compound annual growth rate, or linear rate of return of 8% to 12%, which implies that the stock market is never going to have a down year, which means anybody in a variable universal life theoretically skipped the dot-com crash, the subprime crash, and the COVID crash. And in the software, it opens up at 8% in most of the big company software. And the agent is allowed to raise that rate all the way to 12%, which is the Bernie Madoff zip code. So if Bernie Madoff knew that he could get away with a legit allowable 11% or 12% inside a variable universal life policy, he may never have done his Ponzi scheme, right?
Okay, Elon. So, I've listened in and you've talked, hopefully not over the head of any consumers that are listening or even life insurance agents that didn't write the policy. But you brought up an example that my parents 15 years ago came to me and said, Mark, we want to take out a VUL policy to give to you and your 2 sisters upon our death. I said, that's great. Thank you very much. I appreciate it. I said, show me the projection. And my mom was like, what's that? And I said, well, it's a projection that the life insurance agent is going to show you on how this policy is going to perform. She goes, okay. So she showed it to me. It was run at 12%. I said, Mom, this is a huge mistake. I'm not an expert in life insurance, but I want you to go back to that agent and have her run at 3%. And she did. And the projections were totally different, as you would probably agree on. The cash surrender values were vastly different at 12% than they were 3%. Correct. So I told her, I said, Mom, this probably isn't the best investment choice. Thank you very much for leaving the kids some money, but really it's not your best investment choice. And this is what we see every day in our industry. And I've said this over and over. We see too many policies that were written where the life insurance agent showed the client that policy projection at 8% or 10% or 12%. And if we have a bad year, which let's face it, we do, whether you're tied to the stock market through a VUL or now an IUL or even a standard UL, you have bad years. And if you have bad years with your policy, it's tough to catch up on your cash surrender values. And then you throw in 2 important factors that people they didn't know was coming down the pike. The client never knew that, guess what? The life insurance carrier can increase your premiums. It's called a cost of insurance increase. No one spells that out to these consumers. Well, it can happen. It happens every day. We see it every day in our industry.
You just have to Google index universal life. Mm-hmm.
Yeah, and now people are living longer. So these projections, if you're someone taking out a policy or have already taken out, as I pointed out earlier, people are living to their 90s. If you had a few down years in your policy, you really want to take a closer look at it, maybe run some newer projections at much lower interest rates and see how that policy may look. And if it doesn't look good to you and you still do not need that policy, or you don't need the policy, not still, that's where my industry comes in. As we pointed out, we're able to give clients a heck of a lot more money than lapse, which most of the policies that we see come across our desk, the surrender values are 0. Clients have bled through all their money. Cost of insurance increases have taken them. The premiums have eaten up. And they're going, what the heck happened? I lived 86 and you're telling me the policy is blowing up? And I have to tell them yes. But the good news is, guess what, Mr. Client? My industry is here to help give you some money opposed to 0. So
But 6 times 0 is 0. So I don't know how much you could help them, right? On some of those people.
Well, if the cash surrender is 0, we're usually able to get offers still.
Right. And now you've got the most popular policy called the Index Universal Life, which theoretically you don't have losses, but you also don't get dividends or dividend reinvestments. And the big problem with IULs, and anybody who has an Index Universal Life policy that's listening to this podcast has to pay attention here. Up until 2015, it was the Wild West of illustrations. I could show Mark a 10%, 9%, 10% rate of return eternally. In 2015, the National Association of Insurance Commissioners, the jackasses as I call them in my book, implemented Actuarial Guideline 49, which capped or limited aggressive illustrations. What's the problem? If you have a policy before 2015 that was sold to you at 9%, for instance, and you ran an in-force illustration, the current policy projection, you wouldn't even be able to see the original 9%. It might only show 8%. And when you're upside down in a universal life policy by 0.5% or 1%, the cash value isn't in the ballpark or the Milky Way of where it was projected, and you've got a problem. That regulation was such an abject failure. They redid it in 2020 with Actuarial Guideline 49A, and again in May of 2023 with Actuarial Guideline 49B, which sounds like dork speak from me, gladly a dork financially. But that means if you own an Index Universal Life from before May of 2023, whether you're new or old as in age, and you ran that in-force illustration, agents use the highest allowable rate in the software to show maximum cash value, death benefit, and income stream. That means if the in-force is lower than was shown to you at the point of sale, and you're upside down, you have a massive problem. So effectively what happens, universal life, variable universal life, index universal life, on top of the structural flaws of rising cost of insurance, outliving the census, they all have illogical, irrational, and idiotic investment hypothetical assumptions that show a fixed linear rate of return eternally, which just doesn't make sense. And that's why your audience who own these policies, I think over 90 to 95% of them have a massive problem on their hands. So if they're young, 30s, 40s, 50s, you can get an exit strategy and get into a new policy. But if you're in your 70s, like your demographic that you're looking for, there is no exit strategy. You can take the money and run, but you don't have no life insurance. But if your option is giving them 6x their cash value, that's why they need to call you guys.
So your advice, again, your opinion, if you're in your 70s, call it 60s or 70s, maybe even 80s, and you own a UL product, what would your advice to clients who they want their life insurance, but it's their only life insurance policy that they can qualify for right now? I can guarantee you that if you're in your 70s or 80s, you probably can't get new insurance most of the time.
Yep.
What would your advice to those clients who are in their 70s and 80s be if they own these UL policies? What would you have them go back to their carrier and ask?
Well, if you have a financial advisor, you have to ask, did my financial advisor not realize for the last 10, 20, 30 years that I had a variable universal life policy that was going to lapse? The problem that I find is if you're not coming from a whole life insurance leader, and there's less than 10 real whole life companies, your education on life insurance might be not that good. We know investment managers on Wall Street or asset gatherers have no life insurance background. So before they try to get you to roll that $50,000 into an annuity so they can make a commission, look into your industry, because maybe there's a better option. But I would tell people not to just rely on their financial advisor, because there might be another option, on the outside.
And that's what we see. Financial advisors, wealth managers do come to us, and I'm not beating them up by any stretch. They don't understand life insurance, but they are a wealth manager. They take care of their clients' finances from A to Z, yet you throw in life insurance and they don't understand it. Maybe no fault of their own. They're not life insurance experts, but that's what we see. And I've said it over and over on a daily basis here, where a financial advisor maybe is doing a policy review, which there's two words that I just said. If anybody takes anything away from this podcast, whether you're the life insurance agent that wrote the policy or not, but if you are a wealth manager, if you're in front of your client, ask to do a policy review. You're going to uncover some things that might not make your client happy. They're going to look at their policy and say, whoa, I took this out 15 years ago and I thought it would be up here with cash surrender values and premiums down here, yet it's the inverse. But if you ask and do a policy review, especially what we do in the settlement industry, when we take and evaluate a policy, we get a life expectancy, we get our life settlement offer, and now we can go back to an advisor and say, look, we did a mortality study. Your client has 10 years to live on average by 4 different life expectancy carriers. Here's what 10 years of premiums look like if they want to keep the policy. Here's the life settlement option if they want to get rid of it. And then if there's another option, maybe reducing the death benefit or whatever it is, we give them options. And I think that's one of the most important things a life settlement valuation does. It gives a client a comprehensive view of why it makes sense to sell their policy, or maybe not. Boy, there's several instances where we've done our review and a client's life expectancy is on the short end, and we say, hey, maybe you should keep this particular policy. You wouldn't qualify for a new one.
I think the problem for the average consumer, I'm not talking about the super wealthy guy with the greatest doctors who's going to live till 95 or 98, whatever it is. It's the average consumer. We don't know what his specific death date is going to be, right? So right now you might say it's 87, but what if he lives, these consumers have to forecast or prepare for a long longevity. And the bottom line is once they cross over 70, 75 years old, and those cost of insurance premiums go skyrocketing, A, does he have the assets to pay for the higher premiums that nobody told him at the point of sale? B, will he have enough money to keep on plowing into that every year on an annual basis? And what if he lives to, what I call the death zone of universal life policies, 85 to 95? Will he have money to do so? Because remember, if an average person is on Social Security with negligible financial assets, negligible financial education, they can maybe make 1 or 2 years of these bigger premiums than their normal scheduled $100 premium, but they can't sustain that for 3, 5, 7, 10, 15 years. So if you're 70 years old and you got 50 grand and you got a $250,000 death benefit, it's starting to go in reverse real fast. And that would be the optimal time to try to figure out a strategy that might involve your world rather than see the money depleted when it's too late. Because as people get older, they also lose their cognitive abilities. So they're not seeing their cash value move on an annual basis from 50 to 40. They don't include their kids in many times in their financial affairs for fear that their kids are going to try to kill them for the death benefit, right? And we live in South Florida. Me and Mark, we live in, I live in Boca Raton, Florida, and snowbird season has arrived. It's November. The average age in Boca is 95 to 100 years old. So, this is a real problem. And I wrote the book because I'm a 4-time SEC whistleblower. The regulators, life insurance is too complex for them because they're lawyers. They suck at math. Wall Street life insurance sector analysts are absolutely clueless to life insurance. They went from being in a private high school to Ivy League. They got a master's in finance. They added a CFA designation. They went straight to Wall Street. They've never seen a life insurance policy, and they don't understand the difference between whole life and universal life. Legit. I've spoken to multiple people, and within 30 seconds, I realized these guys have no idea. Plus, they don't want to agree with my book, because if they did, it would imply that they've been evaluating all of these universal life policies incorrectly all these years. Because I think what's going to happen is the day that comes that one regulator says we need to implement an in-force illustration to every client using current universal life rates, maximum allowable in the software and index universal life, and 5 or 6% in a VUL, there's going to be millions of people realizing their policies are junk. And Mark, you're going to start getting a lot of calls, I think. Hopefully, right? Because I
got to stick around for another 10 years in this industry.
Yeah. Listen, I just that's like my goal of the book was, lawyers said the policy language and the illustrations were written by the greatest attorneys on earth, the life insurance attorneys. The regulators are useless. Wall Street's happy with the status quo. And most financial journalists are generalists. They write about Medicare supplement policies and can't spell life insurance. So it's a slow grind pushing this problem up Mount Everest. And my Sherpa is pretty much in a wheelchair, right? So,
well, I'm going to add something. So I've been listening to this
Sure.
very intently. We switched from the viatical settlement industry to the life settlement industry at the turn of the century. Kind of sounds like a long time ago. And I was at a meeting in Las Vegas, and an agent who remained nameless stood up with a gigantic ink press that he would put in every policy. And in large letters, it said guaranteed. And in small letters, it says that this illustration will in no way, shape, or form ever be anything remotely close to what will happen to your policy over the course of the lifetime of the policy.
Yes.
And I never forgot it.
Yeah.
And that's why I own term policies.
Okay.
It's because I believe you just buy the term, cost of insurance. That's it. There's no fancy. You said you're not giving a life insurance company your money to invest. You're giving a life insurance company your money for them to invest, because they're going to take out 100 fees. I saw your water glass. I remember that illustration in your book.
Yep. In universal life, correct. Not in whole life, but in universal life.
Universal life. Which was in vogue, you said, around the turn of the century, 2000s, 2005. Lots of those were written. That's what we see today. My question to you is, you seem to be talking about whole life as the best policy to own. One, why? And two, why does our investment community, the people that buy these life insurance policies, like that policy the least?
Okay. So you asked about whole life. Number one, it's based on a guaranteed monthly premium, a guaranteed cash value inside the policy, and a guaranteed death benefit. On top of that, there's a dividend. The large participating whole life companies, and participating whole life means they offer a policy dividend, haven't missed a dividend in over 100 years, some 150, because 98% of term insurance policies expire worthless. But term insurance is an awesome, awesome product. That means that even if the companies never gave a dividend ever again, your policy would still be guaranteed to work. And that's why your industry doesn't buy them, because there's no such thing as a whole life policy lapse. Because if you make your premiums, it'll never lapse.
No, they buy them. They do buy them. They just don't buy them maybe they're just not, people aren't selling them because they don't have to.
Correct. Yes, correct. But the premise of everything that I've done is that whole life is based on real math, real ethics, and universal life policies are based on a non-guaranteed hypothetical assumption forecast where the insurance companies are allowed to raise your internal charges, something Mark mentioned about current charges going to guaranteed maximum charges. And that's why so many of the policies are in trouble. So when the policy is sold, the agents have the option to design the policy however they'd like. So if I'm walking into Mark's house and I know he has $100 budget, he wants the most amount of death benefit. I want the most amount of commission. That's what target funded is. I'm going to sell him a $100 policy for $100,000. He's going to be really happy. I'm going to make full compensation on that $100 a month premium. Let's say it's annualized premium of $1,200 at a 75% payout rate. I made $900. He has a $100,000 policy. We're both very, very happy. The problem is I designed it for maximum compensation, but that target funded means it's a minimum funded policy, and the minimum funded policies simply don't have enough cash value or juice to hang around long enough to pay the massive death benefit costs when you're 85 or 90 years old. So when we combine all the design flaws, rising cost of insurance, outliving the census, insane investment hypothetical, which has no financial logic to it, the net at risk problem that you have because the investments never do what was forecast, and the fact that I designed a maximum compensation policy for myself, but left you with a poorly funded policy destined to lapse, it's no surprise that 90 to 95% of these policies are in trouble, which means you're going to have a lot of business coming your way, because as people get more and more knowledgeable about the fact that they have life insurance, they're going to need an exit strategy.
And we'll kind of jump in here. We're getting towards the end of the podcast, but what you just said there, Elon, was terrific. And we'll repeat it if necessary. But this is why the life settlement industry exists. We're not here to bash any life insurance agents or financial planners that wrote a certain type of policy, but we are here to show them. You mentioned exit strategies. Yes, my industry, life settlements, is one of those exit strategies. But more importantly, if you're a consumer or an advisor that you have one of these universal life type policies, take a closer look at it. Take a closer look based on projections on your interest rate return. Mm-hmm. Now thinking, all right, am I going to live to my mid 80s when what they're saying, they being the experts, that guess what? Gentlemen are living to their 90s. Females are living to their late 90s. Am I going to be one of those people? Can you answer that question? Maybe not, but you can certainly see how your lifestyle is in your late 70s or 80s and realize that, hey, if your brothers were living to their 90s or your father, maybe you will too. So that was really the main focus that we wanted to bring Elon in and kind of merge our two industries to show that, hey, Correct. If you have these type of products, we're not saying, hey, run out and just get rid of them right now, but pay attention to them. Understand them, which you've pointed this out over and over, Elon, that most people have no idea what they bought 15 or 20 years Correct. Ago. And even the agent that sold it to them, who they're now no longer in touch with, had very little idea. He was writing it for his commission.
So Mark, the problem is when I'm 35 and I write you a universal life policy of any design, I maximize my commission. You're pretty happy when I left the door. The problem is at 65, I've retired. You're 65, but now you realize, holy bleep, I just got an in-force illustration. My policy's upside down and it's scheduled to lapse. Where is that Elon guy? Elon retired. Go try to find somebody at corporate to explain the problem. And guess what? You're an average person. You do not have a legal standing because the contract was probably written with great disclaimers and disclosures. You also don't have the cost or the financial backing to try to hire a lawyer that works on an hourly basis for your $100 policy. A big lawyer won't take it on contingency. So you have no outlet. And I think that's one of the big problems. But I'm very active on LinkedIn. I love the messaging feature. If anybody's on the podcast, connect with me on LinkedIn. And if you have one of these policies, there's a 5-minute video that I made. It's not professionally made. It's just me sitting in front of a camera where I actually explain how to order the in-force illustration. It's a 5-minute video. If you have a universal life policy, an index universal life policy, a variable universal life policy, or a group universal life or group variable universal life, it's a 5-minute video. And if you order that, by watching the video, you'll know what to ask for. And I think that most people are in denial about their life insurance policies. Their investment advisors, a lot of times, are not life insurance savvy. You've got to take that 5 minutes to watch the video, get on the phone for 10 minutes with your insurance company, order the current in-force projection. And unfortunately, you guys are either going to see a 0 in the cash value in the regular projection. You're going to see a 0 in the guaranteed maximum charges section. And a life insurance policy, much like a child's crib, a child's car seat, an airbag, a police officer's bulletproof vest, is never allowed to fail. If there is any chance that your life insurance policy could fail, you need an exit strategy. And unfortunately, I am the bearer of bad news, but I do it objectively because I actually have reviewed over 5,000 universal and variable universal life policies, totaling over $1 billion in death benefits. I'm a 4-time SEC whistleblower. And if you know anything about SEC whistleblowers, we're generally ethical, above average math skills. I'm not inventing the wheel. I'm not creating, atomic fusion, whatever that is. This is basic mathematics. But you have to make that step of watching the video and then getting your in-force illustration. And when you come to the acknowledgement that you have a policy that isn't worth the paper it's written on, that's when you need your exit strategy, which is hopefully how Mark and Rob can help you, right?
Rob, take it away. Anything to add?
No, sir. Elon, thank you very, very much. I think everybody learned something. I'm going to have to go back to school and reread your book, but I'll do that. And again, thank you for your time. Mark,
Absolutely.
over to you.
No, everyone, I appreciate you jumping in. You know, the reason we do these podcasts is to educate folks. We're not trying to sell people on, hey, get rid of your life insurance or do this or do that. An exit strategy has been mentioned many times in this conversation, and that's what my industry is. We are an exit strategy for any consumers, any advisors representing their consumer that may have a policy that they feel no longer meets their needs, is becoming unaffordable due to cost of insurance increases, or the client's just simply looking at the illustration going, what the hell happened? That's what my industry is for. We can provide a comprehensive view of why it might make sense to sell your policy, or as I mentioned, perhaps not. So,
and
Elon,
one more thing. If you do have a policy, don't cancel it. Because if you're trying to get approved for a new policy because you just want to move out to a term policy, whatever you're doing, you never want to cancel your life insurance before your new exit strategy is in place. Because if you cancel it and then get denied for an unknown medical condition, you've got a massive problem. So buyer beware. Be prudent with, because it's a really big financial decision.
Correct. Bill, you want to take it from here?
Yeah, let me pick it up from there, because we know how to get a hold of Elan. Anybody who's listening to this, ELANMOAS on LinkedIn. But guys, if people are listening to this and they have questions for you, Mark, or for you, Rob, what is the best way for them to reach out and get in touch with you all?
Yeah, as always, you can reach me directly on my cell phone any time of the day, 954-326-9378, or my email here in the office, markm@lisettlements.com. And Rob, take it from there.
My cell phone number is 954-599-4433, and my email is rob@lisettlements.com.
Excellent. Great. And for those of you who are listening to this podcast who maybe stumbled across it and are not a subscriber, do yourself a favor and hit the subscribe button, because when new episodes become available, you'll be notified, and you can go back and listen to prior episodes, which I would encourage you to do, because, as has been stressed several times during this podcast, you need to be educated. You need to know about what you own or what you've sold and your options in terms of dealing with them. So until next time, I'll thank you for taking the time to listen today. And I will remind you that you can go out today and make today a great day, or not. That one's up to you. It's your choice. See you next time.
Thank you for listening to Unlocking the Hidden Value of Your Life Insurance, the show that helps you unlock the hidden value of life insurance. Click the follow button to be notified when new episodes become available. Visit our website at www.lisettlements.com or give us a call at our office line at 866-326-5433, extension 1017. You can also directly contact Mark Murky at 954-326-9378 and Rob Haney at 954-599-4433.